U.S. natural gas futures rose above $3.35 resistance on Tuesday following the long Memorial Day holiday weekend. The modest uptick was supported by a combination of factors, including a decline in production, stronger than expected demand forecasts for the current week, and projections for a hotter than average summer that could increase power sector consumption as air conditioning usage rises. Despite flat price performance last week, speculative sentiment weakened. Data from the U.S. Commodity Futures Trading Commission showed that traders reduced their net long futures and options positions for the first time in 3 weeks, reaching their lowest level since April. This pullback suggests growing uncertainty or cautious positioning amid mixed market signals. Storage activity is also beginning to normalize. Analysts estimate that energy firms injected a near-average volume of gas into storage for the week ended May 23. This comes after 5 consecutive weeks of above-normal injections, driven by mild temperatures that limited both heating and cooling demand. Nonetheless, total inventories remain roughly 4% above the 5-year average, which continues to weigh slightly on the market. On the supply front, natural gas output in the lower 48 states declined to an average of 105 billion cubic feet per day in May. Market participants attribute the decline primarily to ongoing maintenance, including work on Kinder Morgan's 2.7 billion cubic feet per day Permian Highway pipeline that moves gas from West Texas to the Gulf Coast. Pipeline constraints have led to gas becoming temporarily trapped in the Permian Basin, causing spot prices at the Waha hub in West Texas to fall into negative territory on several occasions over the past week. Weather conditions are expected to remain warmer than normal through at least June 11 across much of the continental United States, and forecasts indicate a slight decline in total gas usage. Demand, including exports, is expected to drop from 96.8 billion cubic feet per day this week to 95.4 next week. While this week's outlook is higher than last Friday's projection, the following week's forecast suggests softening consumption. Meanwhile, LNG feed gas deliveries have decreased. Flows to the 8 major U.S. LNG export facilities averaged 15.1 billion cubic feet per day in May, down from a record 16 billion cubic feet daily in April. This decline is primarily due to maintenance at several facilities, including Cameron LNG in Louisiana, Cheniere's Corpus Christi and Sabine Pass terminals, and brief unplanned outages at Freeport LNG in Texas. Looking ahead, traders expect LNG flows to remain below April's peak levels, particularly as Cheniere schedules approximately 3 weeks of maintenance at Sabine Pass between June 2 and June 23. In summary, the market is navigating a complex mix of factors. Short-term support from lower production is being countered by softer demand projections and high storage levels. Price direction in the coming weeks will likely be shaped by how these elements evolve and interact. The key question now is, where does the market go from here? While recession fears have not fully dissipated, they appear to be fading, which could provide some modest support for natural gas prices. Even so, my outlook remains cautiously bearish. Unless early June weather patterns bring significantly stronger cooling demand or supply tightens unexpectedly, a sustained move below the $3.20 level could trigger a deeper pullback. For now, prices seem poised to continue fluctuating around the 200-day and 50-day moving averages. Without a clear bullish catalyst, the market may eventually lose momentum and drift lower, potentially targeting the $3 mark in the weeks ahead. Please like, subscribe, and comment to support the channel. See you in the next one.